Okay, with this lecture, I just want to sort of provide a quick conclusion to some of the major concepts we've talked about when it comes to income taxes under US GAAP and the way we account for it, but also just a few extra concepts or a few remaining concepts that we didn't cover in any of the other lectures. And hopefully, once we finish this lecture, you're ready to go through the comprehensive example. And so first of all, let's just summarize some major terms and ideas that we've been talking about. And just as a launching point for our whole discussion, just as a fundamental concept in accounting, accumulated income is captured in net assets. And so if there is income, in some way it must be reflected in an increase in net assets. And if there's loss, it must be captured in some way in a decrease in net assets. And again, this is just a foundational concept or principle in accounting. So the idea here is if the timing of revenues and expenses differs between US GAAP and the Internal Revenue Code, then there will be a difference in an asset or liability under the two systems. In other words, if there is any difference in revenues and expenses, then there also must be a difference in assets and liabilities. The two are tied together, again, because the income accumulates in net assets. And so these two ideas being tied together, that's just a foundational concept in accounting, but it's especially important that you understand these differences between US GAAP and the Internal Revenue Code. All right, so let's kind of walk through sort of a way that we can connect these ideas and then, of course, the way that we've tried to approach accounting for deferred tax assets and deferred tax liabilities. And so just fundamentally, a deferred tax liability or deferred tax liabilities and deferred tax assets, they capture temporary differences in accumulated income tax expense and accumulated income taxes paid. I want to be very clear that the reason I use the word accumulated is because a deferred tax liability or a deferred tax asset may have effects for multiple years. And so you have to accumulate the difference in order to understand what the balance in the deferred tax liability or the balance in the deferred tax asset ought to be. But again, that's sort of the quick and easy idea of what is it really capturing. But at the same time, we know that the income tax expense, both in any given year and as it's accumulated, and the income taxes paid are derived from pre-tax financial income under US GAAP and taxable income under the Internal Revenue Code. Again, it's just a function of them. Well, we also know, from that first bullet up above, that pre-tax financial income and taxable income are derived from the way we account for assets and liabilities under the two systems. And so as we sort of bring all that together, if you kind of connect those three bullets, really the conclusion is that deferred tax liabilities and deferred tax assets, they are ultimately derived from the different ways we account for assets and liabilities under US GAAP when we compare that to the Internal Revenue Code. Again, this is why we've been focusing on differences in balance sheet items as we've tried to provide the journal entries for deferred tax assets and deferred tax liabilities. And again, the idea is the income statement is tied to the balance sheet, and the balance sheet captures accumulated effects from multiple income statements. And therefore, it's potentially, and I think it is actually a better way to think about it, because then you have the balances in front of you. All right, so let's kind of talk a little bit more about deferred tax liabilities and just kind of summarize the things we've talked about in the previous lectures. First of all, when we're talking about the balance sheet and we're comparing balance sheets, if we have a deferred tax liability, then it must be the case that the book value of an asset under US GAAP is more than the book value of the same asset under the Internal Revenue Code, or that the book value of a liability under US GAAP is less than the book value of the same liability under the Internal Revenue Code. One of those statements must be true if we have a deferred tax liability. So thinking about the income statements when we compare US GAAP to the Internal Revenue Code. First of all, if we have a deferred tax liability, it must be the case that accumulated income under US GAAP is temporarily more than the accumulated income under the Internal Revenue Code. This difference in income, again, this temporary difference in income, is what's known as the future taxable amount of income. Everything we've talked about so far has been in the previous lectures. This is, again, is just a summary of it. Again, if we have a deferred tax liability, then it must be the case that the accumulated income tax expense under U.S. GAAP is temporarily more than the accumulated income taxes paid under the Internal Revenue Code. This difference, again, the difference in accumulated income tax expense and accumulated income taxes paid, is what's known as the deferred tax expense. And as a further note, the balance, or this difference, is also the balance in the deferred tax liability account. This deferred tax expense is a new term that I did not talk about in the previous lectures, but many other professors or textbooks or things like that will use this term, and so I just wanted to let you know what it means. Essentially, the deferred tax expense is synonymous with the deferred tax liability account balance. All right, deferred tax assets. So sort of looking at the other side of this. So if we have a deferred tax asset, it must be the case that on the balance sheet, the book value of an asset under U.S. GAAP is less than the book value of the same asset under the Internal Revenue Code. Or it must be the case that the book value of a liability under U.S. GAAP is more than the book value of the same liability under the Internal Revenue Code. In other words, if there is a deferred tax asset, there must be a difference in the balance sheet. Again, thinking about the income statements, the accumulated income under U.S. GAAP is temporarily less than the accumulated income under the Internal Revenue Code. This temporary difference is what's known as the future deductible amount of income. Thinking about the expenses, again, it's the opposite of a deferred tax liability. If I have a deferred tax asset, it means that my accumulated income tax expense under U.S. GAAP is temporarily less than the accumulated income taxes paid under the Internal Revenue Code. Again, this difference is what's known as the deferred tax benefit. That deferred tax benefit is a new term, but it is commonly used, and it is synonymous with the balance in the deferred tax asset account. All right, let's talk about what we might see on the firm's financial statements with regards to deferred taxes. There is discretion in what firms present. Typically, U.S. GAAP income tax expense is what's going to be reported on the income statement. Many times, but not all the time, the firm will disclose taxes paid on the statement of cash flows or will explain the amount paid in the notes. This is not required, but it is oftentimes done. Deferred tax assets and deferred tax liabilities are typically reported on the balance sheet as both current and non-current. So any portion of a deferred tax asset or deferred tax liability that will expire in the upcoming year or operating cycle would be classified as current. Anything outside of that would be classified as non-current. The balance sheet usually presents a summary or aggregated account rather than individual accounts. So there's usually like a net deferred tax asset or a net deferred tax liability. Again, firms could have hundreds, if not thousands, of individual items that create a deferred tax asset or deferred tax liability. In this presentation, we just sort of aggregate them all together. So why don't all firms report income tax related accounts the exact same way? It's pretty simple. Many firms really don't have material differences between the income tax expense under U.S. GAAP and the income taxes that they pay. Many times it's because this sort of net effect works itself out. So you sort of are creating deferred tax assets at the same time you're creating deferred tax liabilities, or at the same time the other deferred tax assets are expiring. So there's sort of this net effect where really the income tax expense and the income taxes that you pay end up being quite similar. And so there's really not a need to disclose a lot of information if it's not material. However, for some firms, there really is a really large difference between what expense they would record under U.S. GAAP and what they actually end up paying under the Internal Revenue Code. And so when there are material differences, those differences really should be disclosed and discussed thoroughly in the notes. All right, let's talk real quickly about permanent differences. Everything we've talked about to this point has been about temporary differences. In other words, a difference that exists for a period of time but then goes away. So deferred tax liabilities and deferred tax assets, which is what we've always talked about, they arise from temporary differences between accumulated income under US GAAP compared to the Internal Revenue Code. I want to be very clear, they only arise from temporary differences. So how do we handle permanent differences? For example, municipal bond interest is tax exempt, but it is recorded as income under US GAAP. A firm could have income from life insurance proceeds on key employees. That's tax exempt. So again, it's income under US GAAP that is not recorded as income under the Internal Revenue Code ever. And so it's not like, oh, well, just not now. It's never will it be recorded. So it's completely tax exempt. At the same time, there are expenses that are not deductible. So lobbying and political expenses are not deductible under the Internal Revenue Code, but we would record those as expenses under US GAAP. So those are a permanent difference in expenses. Life insurance, just like the proceeds are tax exempt, the premiums that you pay on key employees are not deductible. And so again, that's a permanent difference that will never change. Rather than everything we've talked about up to this point, we've been focusing on temporary differences. And then finally, there are some limits on meal and entertainment expenses that are not deductible, whereas under US GAAP, you would expense the entire amount. And so again, I want to be clear, these are differences that are permanent. They are not differences that will at some point go away. They are permanent differences in the way we account for income under US GAAP compared to the Internal Revenue Code. So if there is a permanent difference, should the income tax expense recorded under US GAAP reflect GAAP's treatment of the revenue or expense or the Internal Revenue Code's treatment? Which one should it reflect? In other words, this is not something that's going to eventually be reconciled. There is a permanent difference. So let me give you a hint, or let me give you a couple hints. Just some ideas to think about before you answer that question. First of all, ultimately, expenses are supposed to reflect real economic sacrifices. So we talk about, we book gains and losses even before there's a sale, but ultimately it's anticipation of a cash flow that will occur. So there is an economic benefit in the case of a gain, and there is an economic loss in the case of a loss, even though the cash flow may occur at a different time. So all I want to be clear is that just the principle here is that expenses are supposed to reflect economic sacrifices. Another principle is that income tax expense, if you've been following the previous lectures, we always derived the income tax expense from our calculated income taxes payable and our calculated changes to deferred tax liabilities and deferred tax assets. And so the income tax expense was derived from the Internal Revenue Code definition of income and any deferred tax liability and deferred tax asset accounts. And so if we think about that, with a permanent difference, there is no deferred tax liability and there is no deferred tax asset. Therefore, the income tax expense would be derived from the income taxes payable that we calculated under the Internal Revenue Code. But we know that income taxes payable are calculated from the way we define income under the Internal Revenue Code. Therefore, the income tax expense should reflect the Internal Revenue Code's treatment of any permanent differences. Last item, sometimes the tax code is changing, and so the question is, well, how do I handle deferred tax assets and deferred tax liabilities if the tax rate in the current year is different than a tax rate in a previous or future year? Future year is really what I'm focused on here. So the firm should use enacted rates when calculating deferred tax assets or deferred tax liabilities, and this is the key, in order to reflect the actual cash that will be or was paid. And so use the rate based on whenever you're actually paying the tax. And so let's say that I have a deferred tax liability that's going to expire next year, sort of where it's going to, the income under the Internal Revenue Code is going to be recorded next year. Well, if the tax rate is different next year, I should record the deferred tax liability using that new tax rate. Again, but it must be enacted. It's not, well, it might be. It must be an enacted new tax rate. Of course, we know that sometimes you're in the middle of a deferred tax liability, especially related to maybe a long-term asset. And so if the tax rate changes from an original estimate, the key here is that you update the rate as a change in estimate. So you change your estimate in the deferred tax liability, but you do not go back and restate any prior earnings. It's just a change in estimate.